Meet Aaron. 6 months ago, he was just another trader staring at a screen full of numbers, heart pounding every time the market ticked against him. He had conviction, yes, but conviction alone had cost him thousands. Then he stumbled upon a lesson that would change everything: the one-quarter pyramiding rule. This wasn't just a strategy, it was a lifeline, a framework to turn small, precise steps into colossal victories without risking it all at once. I've seen it countless times and I lived it myself. The amateur plunges headfirst into the market, all in, ego blazing. Every tick against him feels like a personal failure. Every tick for him feels like luck, not skill. That's the difference between the 90% who lose and the 10% who win. A professional knows better. I know better. You don't win by rushing. You win by listening to the market, letting it speak, letting it confirm your hunch before you commit fully. The first secret is simple. Start small. When I decide to build a position, I never throw my entire stake at a stock. If I want 20,000 shares, I start with 5,000, a probe, a question to the market. Am I right? Is now the time? This initial fraction is not about profit, it's about information. And here's the beauty: the market answers. It doesn't lie. A small gain? The green light. Stagnation or drop? Exit immediately. Small loss, small lesson, not catastrophe. Let me tell you about Sarah, a young trader I met in Boston. She had courage, yes, but she was terrified of missing the move. First trade, she dumped her full capital into a tech breakout. 2 hours later, she was underwater, panicking. By the end of the day, she'd lost more than she was comfortable with. Then she learned pyramiding. She started probing with a fraction of her intended position. Small wins built confidence. She added only when the market validated her call. Weeks later, she was executing positions she never thought possible, her risk tiny, her reward massive. This is the heart of what I call mathematical discipline in trading. Each purchase, each quarter, is a brick. You're not building a castle on sand. You're building it on a foundation the market itself has approved. Step 2. The second quarter. Only add after your first probe proves profitable. And here's the twist most amateurs hate. Buy at a higher price. Sounds crazy, doesn't it? Buying higher feels expensive. But when the market confirms the trend, each higher purchase aligns you with strength, not weakness. The profit from the first quarter cushions the risk. The trade is no longer speculation. It's a strategic, market-validated campaign. By the time you reach the third quarter, your position has substance. You've already seen the market's hand, already earned a cushion of profits, and your psychology is armored against fear. Every subsequent step, every additional quarter, becomes a dance of patience and precision. You are playing with the market's own momentum, letting the trend finance your growth. And finally, the last quarter, the apex of accumulation. Your position is massive, built brick by brick, and your risk remains managed, your psychological state intact. This is not theory. This is the exact system that allowed me, and many who studied these principles, to turn small positions into fortunes. It's the essence of professional speculation: calculated, patient, and emotionally disciplined. Let me take you deeper into the psychology behind this method. Most traders think courage is the key. I used to think so too, until I learned that courage without calculation is nothing but a coin flip. The amateur buys all in, heart racing, convinced he's found the trade of a lifetime. Every fluctuation feels like a dagger. Every minor pullback is a nightmare. The professional, on the other hand, is calm because his risk is always controlled. His courage is not blind. It's backed by mathematics and observation. Take Tom, a trader I worked alongside in New York. He once lost $50,000 in a single morning, convinced the breakout would hold. I taught him the one-quarter rule. The next trade, he entered with a quarter of his intended position. The stock barely moved at first. But when it surged, he added the second quarter at a higher price. By the third quarter, he was looking at a position worth triple his initial stake. And if it reversed, his stop-loss ensured he never risked more than a small fraction. The lesson stuck. Your real edge is patience and positioning, not heroics. Here's the key. Each quarter isn't just about buying shares, it's about letting the market validate your judgment. The first quarter asks, "Am I correct?" The second quarter says, "Confirmed." Press the advantage. The third and fourth quarters are aggressive, but still disciplined. Each step compounds the gains, while simultaneously reducing risk. It's an almost counterintuitive psychology. To grow, you must first limit exposure, then let success fund future commitment. And the stops. Never underestimate the power of a trailing stop. The first quarter may have a tight stop, a little cushion to survive normal fluctuations. By the second quarter, the stop moves up to protect profits. The third quarter? Even tighter. By the fourth, your stop almost locks in the bulk of your gains. This is how the professional turns winning trades into a fortress. The amateur, meanwhile, never adjusts. Fear or greed dominates, and positions collapse at the first real stress test. Let's talk about trend acceleration, a phase where the market moves fast and public excitement peaks. The amateur sees the price jump and rushes in, driven by FOMO. The professional, if he followed the one-quarter rule, already holds a substantial position. He doesn't panic. He adjusts stops, watches tape volume, observes momentum. He lets the market finance his risk, riding strength without being caught off guard. I remember a trade in 1922. I built my position using 4 disciplined steps. News broke, headlines screamed, everyone wanted in. The amateurs flooded the market, pushing prices higher. But my position, earned brick by brick, was secure. My stops were set, my psychology intact. When the frenzy peaked, I was not fearful. I was commanding the trend. I knew the difference between those gambling and those speculating. And that difference, patience, discipline, method, is what separates the 10% who win from the 90% who lose. By now you can see the bigger picture. The one-quarter pyramiding rule isn't just a technique, it's a mindset. It teaches discipline, patience, emotional control, and the art of letting the market speak. Each quarter is a psychological checkpoint. Each profit validates the next move. And each stop-loss preserves not only your capital but your confidence. Now let's talk about the cruelest test of a speculator's mind. The market that seems perfect, until it isn't. Every trader faces it. You've built your position carefully, followed the one-quarter rule. The first 3 quarters are profitable, and suddenly the stock dips. The amateur panics. They sell everything, convinced they misread the market. The professional, however, knows the difference between a normal reaction and a real reversal. That's where discipline shines. I remember Helen, a young trader in Chicago. She'd followed my guidance, probing with a quarter, adding the second and third quarters. The stock then retraced 4%, enough to make her sweat. Most would have liquidated, but she trusted the process. She adjusted her stop slightly below her second quarter entry, held firm, and watched the market resume its advance. By the end of the week, she was up 18%, without risking her original capital. This is psychology and math working together, not luck. The genius of pyramiding is simple, yet overlooked. You grow your position only as the market proves you right. Each addition is funded by prior profits. Your exposure to risk is always proportional to confirmation, not hope. Step by step, quarter by quarter, the trade evolves. And psychologically, this is powerful. You aren't gambling, you're executing a system. Each profit builds confidence, each stop-loss protects capital, each new purchase is a calculated decision, not a knee-jerk reaction. Let's address the most common trap. Buying low because it feels cheap. Amateurs chase bargains. Professionals chase confirmation. Buying cheap is irrelevant if the trend isn't validated. The first quarter tests the waters. The second quarter adds to strength, but only at a higher price, following the market's direction. This is counterintuitive but essential. It aligns you with winners, not laggards. Imagine a scenario. The market is surging. The ticker tape screams of momentum. Amateurs flood in, their FOMO blinding them to risk. You, following the pyramiding rule, already hold a substantial position built with discipline. You add the fourth and final quarter only at a new high, the trend unmistakably confirmed. Your position is massive, your risk controlled, your psychology unshakable. You are no longer gambling. You are orchestrating a campaign with precision, letting the market fund your victories. And here's the real secret often missed. Success is not about clever entries, it's about knowing when to sit tight. I made millions not by thinking harder than others, but by holding when others panicked, by letting the trend run its full course. Stops move methodically. The market's reactions are respected, not feared. The amateur sells at every tremor. The professional sits, calm, confident, and calculated. Finally, understand this. The one-quarter pyramiding rule is more than a trading method. It's a mindset of discipline, patience, and strategic action. Each step, each quarter, is a lesson in emotional control. It teaches that capital is precious, that markets speak, and that fortune favors the patient and prepared, not the reckless and impulsive. Now, let's step into the most thrilling and dangerous phase of speculation. The market at its peak, the trend accelerating, the headlines screaming, and the amateurs piling in blindly. This is where fortunes are won and lost. If you followed the one-quarter pyramiding rule, you are not caught in the frenzy. You are calm, methodical, and fully positioned. Your stops are in place, your psychology fortified, and your prior gains now act as a cushion for the final quarter. I recall a morning in 1924. The stock I had been accumulating surged after a news announcement. The amateurs rushed in, driven by fear of missing out. But I had built my position quarter by quarter. The first 3 quarters were profitable. The final quarter went in at a new high, confirmed by volume, momentum, and market behavior. My stops protected my earlier gains. The move was wild, exhilarating, but I did not panic. The market was financing my risk, and my position had become a fortress. This is the psychology of the professional trader. You are never blindly committed. Every step is confirmed. Every addition is aligned with strength. And the most important lesson: sitting tight is the hardest, yet most profitable skill. You will be tempted daily, every tick, every rumor, every headline. But if your analysis was correct, the trend has the power to generate far greater gains than any initial calculation could anticipate. The amateur sells early, the professional holds. That is the distinction that builds empires. Let me tell you about Jack, a young trader I mentored. He was brilliant but impulsive. He often liquidated too early, never letting a position mature. Once he embraced pyramiding, starting with a quarter, adding only as the market validated, he saw the transformative power of patience. One small trade, built over weeks, became his largest gain to date. His fear was tempered by structure, his confidence supported by proven wins. Each quarter was a checkpoint, each stop-loss a shield, each profit a psychological boost. Remember, the one-quarter pyramiding rule is more than a method, it's a philosophy. Capital is sacred. Risk is measured. Emotion is disciplined. You are not fighting the market. You are listening, interpreting, and responding with precision. You let the trend validate your actions. You grow only as the market allows. You never risk more than a fraction at first. Each step compounds profits while controlling risk. And this is why the professional dominates over the amateur. The amateur enters at highs, fueled by greed or panic, risking it all in a single desperate bet. The professional builds patiently, step by step, quarter by quarter, letting profits fund the next stage. The final quarter is not a leap of faith. It's the natural conclusion of a mathematically sound, psychologically disciplined process. By the end of this methodical accumulation, your position is massive, your risk minimized, your confidence absolute. You have let the market finance your growth. You have turned small, cautious steps into a powerful, near unassailable position. You have become the 10% who win. Once your position is fully built, the game shifts. It's no longer about entry, it's about management and discipline. The market will test you. Minor pullbacks will occur. Rumors will fly. Headlines will mislead. The amateur panics, selling a winning position at the first sign of trouble. The professional, guided by the one-quarter pyramiding principle, adjusts stops methodically, protects profits, and trusts the trend. Let's walk through it. Suppose the fourth quarter is in place, the trend confirmed, and the position substantial. You now trail your stop gradually above the level of prior profit, giving the stock room for normal fluctuations, yet locking in most gains. This simple act turns a risky trade into a fortress. You are no longer gambling. You are defending a position built on confirmation, mathematics, and psychology. Consider Emily, a trader in Philadelphia. She had accumulated a line of stock using the one-quarter method. A minor retracement occurred. Most traders she knew panicked, selling half their positions. She adjusted her stop to just below her third quarter purchase, letting the trend continue. Over the next week, the stock surged 15%. Her calculated patience turned what could have been fear-driven losses into significant profit. This is the mental edge of professional speculation. It's crucial to understand why this works psychologically. Every quarter bought is a checkpoint. Every profit protects the next move. You are building confidence alongside capital. The market becomes a teacher, validating your every step. Your emotions shift from fear to disciplined courage. You learn to sit quietly in the storm, letting the trend do the work. A key lesson: never average down blindly. The market does not owe you a second chance. The amateur adds on weakness, hoping to recover, risking everything. The professional adds only on strength, always at higher prices, aligning with momentum, not fighting it. This is why patience, discipline, and observation trump raw courage. Now, let's talk about trend exhaustion. Even the strongest trends eventually waver. Here, stops again protect gains. Observe volume, momentum, and reactions to pivots. The market will signal when it's time to exit. This is not timing by guesswork. It's timing by observation and confirmation. You have learned to read the tape, respect price action, and let the market guide your decisions. Remember, the one-quarter pyramiding rule is not merely a technique. It is a philosophy of trading as a disciplined business. Each step, each quarter, builds wealth while preserving capital and mental composure. Step by step, profit by profit, the professional moves through the market with calculated courage. The amateur gambles, hoping for luck. The professional follows a system, letting the market finance his victory, protecting himself at every stage. Now comes the ultimate test, the peak of the trend, when euphoria grips the market and amateurs are blind with fear of missing out. The ticker tape is alive, volume surges, and news headlines scream about easy money. Most traders at this point panic or chase, entering positions at the very top. But if you followed the one-quarter pyramiding rule, you are ready. You are positioned methodically, with stops in place and psychology intact. You are calm while chaos reigns. I remember a trade in 1925. The stock I had built gradually surged, breaking all-time highs. Amateurs were frenzied, piling in recklessly. Yet my four-quarter position was complete. My stops protected previous gains. I didn't touch the position impulsively. I observed, adjusted, and let the trend finance my final stage of risk. The market itself dictated my next steps. By the end of the week, profits were extraordinary, and risk was minimal. This is the hallmark of professional trading, letting the market guide, not ego or fear. Every addition was confirmed. Every stop was calculated. Every quarter of the position was built on proof, not hope. Emotion no longer rules. Courage is guided by observation. Risk is managed mathematically. The amateur may feel excitement, but it is unstructured and dangerous. The professional experiences excitement without being swept away. Let's examine the psychological mastery required. You must resist the urge to sell early, resist FOMO-driven entries, and trust your preparation. Every quarter purchased is a checkpoint, every profit a cushion. You have built a position on logic, confirmation, and disciplined risk management. Your confidence is not arrogance, it is earned. Your patience is not passivity, it is strategy. Consider Leo, a trader in San Francisco. He built a position using the one-quarter method. As the trend accelerated, he adjusted stops progressively, letting profits accumulate while guarding against reversal. He didn't panic when the stock surged wildly. When a minor correction occurred, he maintained composure and adhered to his system. By the time the trend exhausted, He had maximized gains without risking a single quarter unnecessarily. This is the power of controlled patience. Finally, understand this. The one-quarter pyramiding rule is a system for long-term trading excellence, not just a single trade. It teaches you how to align your decisions with the market, protect your capital, grow confidence, and master your emotions. It's a method to transform small, cautious entries into substantial, profitable positions, while keeping psychology and risk under control. Every quarter is a lesson in discipline. Every gain is proof of alignment with market forces. Now we reach the final, most delicate phase, exiting the trade. Many traders think this is simple. Just set a target and sell. But the professional knows the market rarely respects arbitrary levels. Exits must be guided by behavior, not guesswork. Watch for signs: diminished momentum, declining volume, failure to rally after minor reactions. The market speaks, and if you listen, it will tell you when the trend is ending. I remember a trade in 1923, during one of my biggest campaigns. My line was massive, built quarter by quarter. Headlines were screaming, the public was euphoric, and amateurs were buying at every peak. But I had learned patience. The trend began to show subtle signs of exhaustion. I adjusted my stops, preserving the bulk of my gains, and exited gradually. The final quarter sold just as the market reversed sharply. Every step was guided by observation, not hope or fear. The result: my risk minimized, my profits maximized, my psychology intact. Here lies the greatest lesson of the one-quarter pyramiding rule. Trading is as much about the mind as the market. Each quarter teaches restraint, each profit builds confidence, each stop-loss protects not only capital but emotional stability. A trader who masters this method learns that wealth is built gradually, systematically, and with patience. The market rewards those who act logically, not impulsively. Consider Mia, a trader who struggled with fear of missing out. She entered trades too early and sold too late. Once she embraced pyramiding, she discovered a rhythm. Initial probes were small, risk was limited, and subsequent quarters followed only with confirmation. Her confidence grew not because of luck, but because of repeated, controlled success. By the time she exited, she had maximized gains, avoided panic, and learned the value of discipline. And here is the final, psychological truth. Your greatest ally in trading is yourself. Capital preservation, emotional control, patience, and disciplined risk-taking are far more powerful than any tip or indicator. The one-quarter pyramiding rule is not merely a strategy. It is a self-improvement system, teaching mastery over fear, impulsivity, and ego. Each step reinforces not only financial gain but personal growth. In conclusion, remember this: the amateur gambles and loses. The professional builds, step by step, quarter by quarter, letting the market validate every move. Gains are compounded, risk is minimized, psychology strengthened. Wealth in trading is not born from luck. It is forged from discipline, patience, observation, and the courage to follow a proven process. This is the legacy of professional speculation. This is how fortunes are made and preserved. Let's step back and see the full picture. The one-quarter pyramiding rule is more than just buying shares. It's a philosophy of disciplined action, patience, and self-mastery. Every trade is a lesson, every quarter a checkpoint, every stop-loss a safeguard for both capital and confidence. The market becomes a teacher, not an adversary. Your success is not luck. It is the result of aligning your decisions with proven principles and the natural rhythm of supply and demand. I want you to picture yourself in the shoes of a professional speculator. Your first quarter is a probe, a test. Small, cautious, almost invisible. If it succeeds, you add the second quarter at a higher price. Step 3. Another quarter, built on confirmed strength. Step 4. The culmination of careful, methodical accumulation. At each stage, your risk is controlled, your confidence grows, your psychology is strengthened. By the time the trade reaches its peak, you are not gambling. You are orchestrating a strategy, letting the market finance your victory. And here's the ultimate psychological insight. Wealth is created by patience and discipline, not impulsive courage. Most traders fail because they act too quickly, too emotionally, too desperately. The one-quarter pyramiding method teaches restraint. It teaches how to trust the market's verdict over your ego. It teaches that every loss can be small, every gain can compound, and every step builds mastery, not just over the market, but over yourself. Think of the market as a teacher that rewards the prepared and disciplined. Each probe, each confirmation, each calculated addition reinforces not only your capital but your mindset. This is the distinction between the 90% who lose and the 10% who win consistently. The professional does not chase, panic, or gamble. The professional observes, confirms, executes, and preserves. Emotional control becomes a skill, patience a habit, and disciplined action a lifestyle. Finally, remember this: the one-quarter pyramiding rule is timeless. It is the essence of professional speculation, the psychological armor of the disciplined trader, and the method to grow small, cautious beginnings into powerful, profitable positions. By internalizing this system, you are not just learning to trade. You are learning to master your mind, your decisions, and your capacity for long-term success. If you take one lesson from this: start small, confirm, add only on strength, manage risk, and sit tight. Follow these principles, and the market will reward your discipline. Ignore them, and you risk falling into the trap of impulsive, destructive speculation. The choice is yours, and your future as a trader depends on it.